If you're watching this video, you're likely a trader looking to grow a small account, whether you're a beginner or intermediate, whether you've been around a while and you're just looking to start from scratch. Small accounts are hard to grow, and they're harder to grow than ever in 2023 just because of the prices of the options out there. There are stocks that I trade that have options prices in the $25 range for the bid and the ask on the regular. Small account, you can't buy enough to even have one contract in the options. The answer, I believe, is in two indexes, and we're going to talk about one here today. The Qs, the triple Qs, ticker symbol QQQ. It is the place, I believe, that you can not only leverage your small account to buy several contracts, up to 10 contracts, maybe more, on a small number of dollars in your account. So you can leverage your money, but you can also leverage the momentum of the market. You can trade when big stocks are moving and leverage your money on those movements without having to have a big account. That's the beauty of the QQQs. There's some downsides, but that's a huge upside. And so we're going to dig into how to leverage the Qs with a small account and grow it from, say, $1,000, $2,000 to a point where you can afford just about anything options-wise in the stock market today as we record this video.
The views and opinions expressed on the Rob Review do not represent the views and opinions of WIG TV or any associates. The tactics given within are tactics that work for Robbie only, and your results may not be duplicated the same as the circumstances may be different. Your use of the Rob Review content to better your own life must be taken at your own risk. Understand that I recommend everyone consult their own financial professional before moving forward.
What you can expect to learn in this video. This video, if you pay attention by the end, you will understand how to grow an account from $2,000 on up to $15K, probably more. What kind of setup to look for on the QQQs to maximize profitability. How to enter a position, what kind of options you're looking to buy, what kind of strike price to buy, the main times of the year to focus on trading the QQQs for maximum leverage based upon my research and trading the Qs for well over 7 or 8 years now. And how to structure your trades for any schedule. At the end, we're going to talk about a growing strategy to take the money in that account, that $15K or more, and how you can leverage the compounding effect of certain accounts to grow into the 6 figures and beyond just by trading the triple Qs. So here we're looking at a real options trade I did on the QQQs, the last seriously good one I did. I used the daily chart for both my action and my decision to enter the trade. Daily chart's a very leisurely way to trade no matter your time frame, okay? The entry, it was on a bounce. We knew it was going up. The weekly chart said it was going up, and we enter. And as you can see here, each candle represents a day as we move forward in time. I'm showing you recording this after the trade was exited, and I went back to the entry candle and moved forward to show you each day the thought process of the possible exit. Right here, as the daily flattens out, I thought about exiting. It started to go sideways. The probability was high that it was going to bounce off the rising 3-period moving average and go higher. And as it did, you can see that here we're going to hit that declining 377 moving average, and that is going to be the best possible exit for your money. Okay, that was a real money trade I did with the QQQ's options. And I trade during March a lot of times with the Qs. There's several times of the year where you're going to see QQQs move well, and we'll talk about that in a minute. But what did I buy there? Why did I buy there? Well, the charts were set, and we'll talk about what I've been taught to see as a chart setting up to move. But the main thing is we're moving with the trend. we're going into the next earnings season, which is April. So we have a catalyst and we have the trend moving in our direction on the weekly. The daily has declined in the indicators. It has the fuel to rise now. And where do we buy? Well, based on the positioning, I've always been taught to buy out of the money calls. So we're looking a couple of strikes out of the money. The further out of the money we buy, the further the price has to move to get us into profit. That is true. However, the out of the money that we buy strategically allows us to have what I believe to be a highly profitable option as opposed to buying in the money or near the money, okay? And so buying at the 295-ish period where the Qs were, I look to buy the 300 out of the money call options. I bought 10 contracts, and I did some other stuff we'll talk about later to offset the downside in the naked puts. Now, the Qs obviously went up from there, and that was a very profitable trade for me. I was in that trade for about 15 days and got out with a several 100% return on my money. And this is why, because you're buying out of the money options, if you do it that way, you're able to leverage small accounts because out of the money costs less. I bought into that trade for, I think the bid was around $5 and the ask was around $5, right? And so you always, when you buy options, if you're a beginner, you buy at the ask and you sell at the bid, okay? Now, usually speaking, especially with the Qs, the spread there is very thin, sometimes 30, 40, 50 cents, sometimes $1, very rarely not. But the option spread, you just want to buy the strike option that you think it has the strongest possibility to move into in a very short amount of time, with the smallest option you want to buy being one strike out of the money. So if the Qs are at 295, one strike would be 296. So 300 would be about 5 strikes out of the money. And because I bought so far out of the money, yes, it had to move a lot, but I knew based on my potential research, practice trading, that there was a high probability of it moving in my direction. That out of the money purchasing allows for high return probability in my experience. And we'll talk about the trades I've done over the past 2 years in this account from 2021 through 2022 to now. We'll just go over some of them so you can see the compounding effects of returns when you're buying out of the money like that. I decided back in 2021 to start trading the Qs exclusively in one account. And at that time in my life, unfortunately, I just didn't have a whole lot of money. So I had to start very small, spreading my money between several accounts. And so I started an account with about $2,000 just to trade the Qs. Now, the why doesn't really matter. Bottom line is, as a trader, you have to be disciplined with your money. And I, earlier in my life, was not. I want you to focus on you and the small account that you have, and the fact that you feel like you can't get started in options because you don't have the money, as a lot of people say, probably have said to you, and probably say about themselves. Options are a rich man's game, blah, 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 blah. It's all bull, man. It's truth be told. Once you wrap your head around options and the profitability of options, you may never go trade stock again. And here's why. In February of 21, I did my first Qs trade in this account. As you can see here on the stock chart, the daily chart I was trading, entry, it dropped from about 330 price to about 311 before I got out. That was a highly profitable trade of about 300% return in my money. Why was it so high? Because during February, especially around that time, puts are priced very well. Things drop faster than they rise always, right? The law of gravity. And so your returns in a put can be quicker, faster, and more profitable in some parts of the year than calls. Here's one in October of 21, 105% return, a call during a time when we generally expect calls to occur. November, December, I had a loss of what I thought was going to be a put. It wasn't a put. I got out with about a 10% loss. Okay. You can pick maybe 10 to 12 times a year at most that you want to trade them. Plan your trades. Plan around major market movements by doing back work and by doing practicing. And you're not going to overtrade, and you're going to put yourself in a position like a lion looking for the easiest, juiciest prey. Here's 22. January, 100% return on a put. February, a nice little break even, and I'll talk about how I did that. I broke even on the naked side of the trade. March, upside call. March is generally a good place for that. 127% return. April, 165% return. June, a loss of 15%. August, a gain and a massive put of 350%. That led to me taking a $2,000 account to a lot of money. Okay, I don't want to say how much, you can do the math, but it was a nice sum of money. And the reality of the fact of the matter is I am no more intelligent than any of you. And that means you can do it too. And that's the power of the Qs. And later I want to talk about how in the right account you can compound that money. Because the big part about not making a large amount of money on a small sum is because every trade you're giving money to the tax man, right? About a third of your profit goes to pay your taxes because it's just what you got to pay to play. Downside of that is that if you do not know that there's things out there like self-directed IRAs where you can compound your money without taxes, you don't realize that that 1/3 not chipped off comes to a large sum, and we'll talk about that here in a minute. Now, I want to get to the what of this equation. We talked about trading them. You've seen examples of trades. How do you know when you see a Q's trade that it's going to work? The answer is you don't. You never know 100% of the time in the stock market. The stock market is all about probability, mindset, discipline. And in a book, I believe it was A Disciplined Trader, or it might have been Trading in the Zone, I read a paragraph that said something to the degree of a trader that is at peace with the idea of not knowing what's going to happen next is a trader that can be consistent. Because then you can truly look at the charts for what they are and what they tell you rather than what you want them to do. And that's very, very vital to doing anything in the market optimally. So you never know. The answer to the question is really another question in asking, how do you put probability in your favor, on your side? And you can do that. This is not gambling. The way to do that is to set up a plan, is to have a trading plan. You build a recipe for success by planning around the times of the year when you're going to trade the Qs. You go ahead and say, look, I know that based upon my research or based upon listening to the Rob review, that mid-March is a good time to trade the Qs. July is a good time to trade the Qs. Mid to late August, mid-September, great times to trade the Qs. October, great time to trade the Qs. January and February, especially mid-January and mid-February, excellent times to look for trades on the Qs. And if you notice that most of those time periods are around earnings, or if you look at the trades that I was doing examples of earlier, if they weren't around earnings, or even if when they were around certain times of the month. A lot of trades happen and occur at the momentum of the end and the beginning of the month, as I have been taught and found to be true. It's something about that period of time. And you learn that through practice trading and research. And then you write down and you keep to that. if you see an exceptional trade setup outside of those time periods, you can do it. You just got to know that probability is not as high on your side as it would be during the times when you plan to do the trades. It's about 100% of discipline 100% of the time. Okay? Now, trade off the daily charts no matter what. In my opinion, this strategy works best off the daily. And no matter your time schedule, no matter where you work or what you do, there's always a way for you to check a daily chart, because you enter before the market opens or after the market closes, and you can always look at it at some point before the next day. So you're checking it on a daily basis. It's a very, very lazy way to trade in a positive way. Then watch the trade coming to you from the opposite direction. This is an important point. I had to learn this the hard School of Knox way. Trades do not happen out of the blue. They build the best trades. You watch them pushing you, and then boom, you hit them with everything you got. So, if you look back at my examples, let's pull up one of those charts. You can see where I entered a call from the downside momentum popping up into a call. Or I entered a put off the upside momentum, pushing that Bollinger Band until it pushed back and popped it to the downside. It's a very symbiotic relationship with the market always ebbing and flowing, and we as options traders pick out those chunks in the middle. We want to do the majority of our trades, 80% or more, with the momentum of the trend. I get my trend from the monthly and the weekly charting setups, meaning whatever the weekly's doing, I'm going to look for trades to go in that direction. And you would be smart to listen to that and move with that. You also want to practice more than you do real money trades, especially in the beginning. I'm talking about massive practice, like 100 to 1, 100 practice trades to 1 real trade. You don't do that in your daily work, you do that going and getting a charting service and taking them back historically and doing research. It's the way I was taught to do it. Now here's the thing. When I started out, especially when you have no confidence in your ability, which is natural, I didn't put all my money into every trade. Not like I did when I was just showing you those examples. That example scenario for those past 2 years that I've been doing has been an experiment with a certain amount of money that I was comfortable losing. And the money that you put into your trading account, you should be comfortable with never seeing again. So, if it's all you got, don't trade it seriously. And if it's all you got but you're willing to put it on the line, don't put it all into a trade. Keep half of it in your account and half of it as an X amount of money to put in your trade. And stay with that amount. Say if you've got $2,000 in an account, trade 1,000, 1,500 of it, and don't deviate from that until you're ready to move it up with a growing account. More importantly than that, when you find a trade that you're willing to put the money on the line for, don't put it all on there. If you got 1,500 going in or 1,000 going in for easy math, 70 to 80% of it at the first entry point. And then once you see it flowing in your direction a day or two, dump the other 30, 40% in there so that you've got 100% of your X in the trade now, and you've got the momentum knowing that you're not going to lose it all. Limiting your downside risk. An important key factor to growing an account is knowing how to get in and risk-reward ratio, right? Knowing where to take the risk with the highest probability of return. Even more important is how to limit the risk when you are in. Okay? How do you do that? I believe by buying out of the money options. All the way up to 6 months of time out of the money, you limit that risk. You give yourself time for the thing to work. Secondary to that, trading in the naked. I don't mean trading nude. I mean naked side of your position trading. You see, on those trades, when I broke even or I had small losses, the only reason that I had such a small loss is because I was able to cut the trade early, cut my loss early, but I was also in the naked part of the position. When you trade a call, if you do a naked put, the call losing value, the naked put goes up in value, it can offset that loss. It's a hedge against being wrong, and it also, unanimously, gives you money up front. See, when you do a naked call or a naked put, which is the opposite side of your position, you do have to trade on margin if you don't have an account enabled with the right amount of money in it. So you need to wait until you build up an account where you don't have to put your margin at risk, and you can have the ability to do that naked side position. But once you get there, you know what's cool is they pay you up front. You ever heard about, like, that is so, I love that part because they pay you that day. They send you the money, put it in your trading account. You could pull it out if you wanted to. The only thing is, when you get out of the position, you got to give them back what's left. Most of the time, you're going to be in a position where you're going to give them back less than they paid you. Sometimes, though, when you're wrong, you're going to give them back more. But a lot of times on the naked, say if I do 1,000 shares and I sell the naked up front for $5 on the bid, well, that's $5,000 they're going to pay me up front. And then later on, I can buy it back at an ask of $2 or $3. I keep the difference of the $2,000 or $3,000 in my account. Now, naked trading is a serious endeavor, and you don't need to do it without understanding how to do it. And I'm not saying you just go out and bullishly, stupidly do it without research and practice. Don't do that. But it is a feather in your cap of knowing how to use that tool eventually when you get there. IRAs, what I consider income replacement accounts, because over the lifetime of your IRA, once you understand the power of the compounding, like I've been taught to understand it, you will actually be excited about an IRA for once in your life, and excited about making sure that you use it to its fullest potential. Because what's the best part about an IRA, ladies and gents? The compounding effect. That's right. Just like the book, the compounding effect on an IRA can be staggering when done properly. And I'm not talking about investing. I'm not talking about investing in some regular old growing company that grows at 5-10% a year. I'm talking about trading your IRA strategically, using a QQQ's method like this to do like 6 trades a year on average, let's say 25-50%, and you actually compounded, meaning you took the principal start of the $2,000, like we talked about in our earlier example. And even if you didn't have the gains like I told you I had, if you had an average gain of 25-50% in an options trade, and every time you reinvested the principals and the proceeds into the next trade, the rollover effect, you would have a staggering amount of money in that account. I can't tell you how much it is because I've only done the math on my example, which is following the current trade volume that I did in 2021 and 2022. If I did that in an IRA, which I'm thinking about doing and filming a video of, starting with a small amount like $2,000, compounding it over, having those gains, even those losses, you would still be at over $1 million in an IRA, really closer to 2 in an IRA in less than 3 years. Most people, go look it up, the average amount of people that have 7 figures in their IRA when they go to retire. It's very, very small. And if you are at any age, 50 and younger, watching this video, you have the ability to do 6 trades a year on average for the next 10 or more years, compounding that kind of return to have well over 6-7 figures in an IRA really easily. Now, nothing's as easy as it sounds. There's going to be work involved, and this is, again, not financial advice, it's education. But which looks better to you? An IRA growing at 10% like yours may have been, or an IRA growing, compounding in cash when you're not trading it, and in a trade when you know you have the probability of the advantage, compounding at 100, 200% a year. Because it can be done, folks. I've done it. I've seen it done. I'm not going to swear to it that you can do it, but I believe if you have the intelligence to look up a video like this, again, do it at your own risk, but I believe in you. Okay? Now, with that, I have nothing further to add to this video because I believe your mind's probably blown enough. Go forth, take what you will from this QQQ strategy, open some kind of account if you want, and get going. If you have any questions, email me or leave them in the comments below this video, and I will be glad to answer them if I can. Again, I'm Robert Morris. I'm your friend in success here with the Rob Review. I'm not a financial advisor. I'm educating you based upon my experience. So I can't give you financial advice, but I do want to see you succeed. Until the next time. Thank you for tuning into the Rob Review today. I hope you got what you wanted out of this show, and I hope that if you did, you stay tuned to watch the next video here. See, this video has been selected to be the next thing in line that you need to see. Now, as I work with these strategies that you're learning, that you're watching about, I always tweak them. They're ever evolving. And right here could be the video where I use this strategy in my own account and you get to see me trade it, or where I've taken the strategy that you've just learned and I've updated it for a better way to use it in today's times. I'm constantly learning, as I believe a successful person should. None of these strategies are set in stone, but I am here to be your friend in success and your helpful hand in creating options for your life with options. So let's get going. Let's get to it. And whether or not you need to see this video now, I believe that it's going to help you in your journey. So either take what I have taught you in this video you've just watched and apply it, or if you want more, if you're ready for more, dig in deeper and stay on the Rob Review to help us at this channel and to help further your education while you're in the zone. I'll see you on the next one.